Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation.
Welcome to another Market Radar podcast. It is October 15th, 2022, and the year-to-date performances for the major indices are as follows. The S&P 500 is down 24.7%. The Nasdaq is down the Nasdaq 100 is down 34.5%. The Russell 2000 is down 25%, and the Dow Jones is down 18%. So in the last week, we saw stagflation odds shift down slightly, about 50 or so basis points, and we saw deflation tick down as well. Meanwhile, the system strength did tick higher, and along with that, we saw the inflation and expansion or risk on probabilities tick higher as well. We saw the overall risk off probability tick lower from 74 to 73%. So long story short, we're still in a high conviction risk off regime. Let's go over the economic calendar for the upcoming week. So on Monday, we have Empire State Manufacturing Index. On Tuesday, we have Industrial Production, Housing Market Index, Bostic speaking, Treasury International Capital, and Kashkari speaking. On Wednesday, we have Housing Starts and Permits, EIA Petroleum Status Report, Kashkari speaking again, Beige Book, and Evans speaking. On Thursday, we have Jobless Claims, Philadelphia Fed Manufacturing Index, Existing Home Sales, Leading Indicators, EIA Natural Gas Reports, and Harker speaking. And on Friday, we have Williams speaking and the Baker Hughes rig count. So let's go over what happened last week. We had a few important economic releases, starting with PPI. We had PPI come in with a 40 basis point change month over month, and we see that this is now seeming as if it's climbing back towards the prior high that was set in June. Markets didn't like this too much. Again, this is showing that inflation does remain sticky from a producer level. Remember, this is a producer price index, so this is at a producer level. Now, we also saw the core producer price index, or the core PPI, rise as well. Unlike the PPI that seemed to have a bit of a slowdown, the core PPI never actually had a declining print, at least in the last year. And we were having this prior print that we just saw come in at 7.22% year over year change. So it's still way up there, even with PPI. It's at 8.55%. But as you can see with PPI, we're well off the 12% peak. Here, we are just off 9% at 7. So this is not down as much on a rate over change basis. And we also had the month over month print come in at plus 30 basis points. So again, this is continuing to signal that inflation remains sticky at a producer level. We had then the consumer price index, so CPI headline, come in at 8.22% year over year. And this was above expectations. Surprisingly, I did think that this would come in a little bit weaker because of the slide in commodities. So we got an 8.2, call it, percent print with a big slide in commodities. It's not good, meaning more carnage needs to happen on the commodities level to really break this figure. And if we take commodities out of the picture, we get core CPI, and that was actually much worse. Core CPI came in at a higher print than prior this year on a year-over-year basis, rate of change. Obviously, the prints have been consecutively higher on an index basis, but on a year-over-year change, we are now almost at 7% on core. Not good. Not good. Everyone was looking for, while they were expecting a rise here, to this magnitude, people were not expecting. And so be it when we have this type of runaway inflation, once we get past the headline figures, because headline is the most volatile. It moves the largest because it has that commodities component. Well, once you have inflation running away without commodities as a component within the index, well, then you have something that is, or inflation, I should say, that's being embedded into the economy, which is what core is telling us. Outside of commodities, core is continuously rising, which means inflation is now been, call it like a virus, spread into the economy, and it's no longer just confined to runaway commodity prices. We had jobless claims come in plus 20% month over month from the prior monthly close figure. We are up off the September figure or month end figure, but we are still well below the July figure. And a lot of the year over year print here from last October, we're still down 18.57%. So jobless claims are still subdued, which means employment remains tight. We had the United States crude oil stock changes come in with a positive print. And remember what I've been saying. It's not where this print is going, but where the cluster has been. So when we have a bunch of clusters in negative territory, well, that pushes price higher. And once we start getting a bunch of clusters in positive territory, it's bearish for price. The question is, we saw this rally in crude in the last week and a half, 2 weeks. And if we start getting a bunch of positive prints here, well, it's most likely going to be a fade trade where crude rolls over. Crude is still bearish trend, so we have to pay attention to that. It's when we start seeing these clusters of prints shift back down to negative territory where we start to get these types of moves where crude can excel again. And when it's balanced between positive and negative territory, you get what would seem like this price action here, where crude is almost going nowhere, and we need a solid shift in prints in either direction to really break that trend. So we had retail sales month over month come in at 0. Again, this is, zero is never a good number, right? Especially when talking about sales, but we're nowhere near negative prints that we saw even back in 2008 in COVID, or just earlier this year, or mid last year. I'm sorry. So again, this is not really too weak, not really too bearish of a data point, at least not yet. We had United States retail sales, excluding auto, actually come up plus 10 basis points month over month. Again, not in negative territory yet, not really looking too weak or bearish. We had the export price index come down. We're seeing this now, this change on a year over year basis at 9.52%. And we are seeing both month over month and quarter over quarter figures in negative territory. So maybe this is a start to show weaker price or product or pricing that, or prices that we're exporting, smaller prices, weaker pricing, maybe to lead to lower inflation. It depends, though. Unfortunately, inflation is so embedded in the economy that we can't just look at one factor and really determine what is going to happen to inflation. But obviously, this is a good sign. This is a good bullet for lower inflation. Same thing with import prices. We're seeing these come down as well. So again, another sign that inflation somewhat is slowing. The problem is does this stay or does this fade? We will have to see. Total business inventories still up 18.24% year over year. Nothing bearish here yet. Something to watch. But usually, when these indexes or year over year changes are so positive, you're usually not going to get what we would see as a direct recession. It's when these things shit the bed hard that we get the strong signal that there is a recession, as in 2001 and in 2009. Both the year over year change for business inventories fell below -5%, and those were and even in the 2020 COVID crash, obviously we fell to -5%. So we are well above -5%. Hard to see that there is a recession here just yet. Again, this is what we've been saying. The recession is around the corner, but it doesn't seem, while technically we are in one, from an economic production perspective, we don't seem to be there just yet. And that's why the system continually holds the stagflation stance and hasn't pivoted so far to deflation. We had the University of Michigan consumer expectations come in at 56.2. We are well above the yearly low, this year's lows, or just above, I should say. We're above 50 though, which is the contraction mark. So this continues to hold, and above 50, which we've been talking about, but we are still well off the early year 2021, mid 2021, or even 2020 highs. So this is still downtrending and showing an overall deterioration in expectations over time. The question is, do we see this breakdown big, or is this going to hold on for dear life and stick around these poor values throughout a recession? If a recession isn't here yet, when it does come, where do these values go? I would assume that they would go much lower, but we have to watch and see. University of Michigan consumer sentiment. We are also, again, pre-COVID, this was printing 100. Post-COVID, the highs were about 88. I'm sorry, 88. And now we are in the high 50s. We were at 50. We bounced off 50, but we are in the high 50s. So we're well off the pre-COVID peak. Sentiment continues to seem to be downtrending. Again, if we do get a pivot into a real deflationary situation, where this goes, I would guess much lower than 50. Now, let's go over ES in the prior week. So we had a lot of wish-washy action going on here in the last week. We had we closed only down, I think, 153 basis points to be exact. So we closed down 153 basis points, but we had a volatile week where we had CPI numbers, the market fell, and ES hit lower vamp, and it reversed quite quickly and ripped. Then this was on Thursday. Then on Friday, we pushed higher only to reverse and sell lower into the close. Now, we've been saying this for some time that the market seems to be quite oversold in a straight line. So if I were to make this a line chart, it may look a lot easier, or might be a lot easier to understand. And I put a line, just like kind of through it, right? Let's draw this line like this. Market's down almost what seems like a straight line in 2 months. While there are some chops in between, we haven't had this like a typical counter trend move where price really excelled off of lower ramp and held. And what I'm referring to is something like this, right? Where price kind of lifts off or does lift off lower ramp, holds, and then falls apart again. Even this itself is a relief in negative momentum. And we have not seen that yet. We've seen these pops that get quickly sold, and we are now at just above the prior 52-week lows. Let's look at SPY, might seem a little bit better. When you open up at lower vamp, a lot of people get scared and they initiate instant hedges and liquidate. And when you get this type of move, those hedges are down. They have to cover, and their liquidations are now going against them, right? Because you sold the bottom and it's moving back up. So you chase to buy back in, and you get what creates a squeeze. And now we're reversing that squeeze. So the question is, do we invalidate all those people that bought hedges, sold them, and have to rebuy them? And basically you're taking double L's here. We're going to see. Long story short, though, we do think the market can rally upwards. It's very possible the market can see upper vamp, especially on upper vamp is 38.42. We're going to hold our calls to expiration. They expire on the 28th. After that, we'll reassess the situation. But long story short, again, markets do have the possibility to rally. We're still holding that short, though, in case it wants to shit the bed, because, again, we have to play the regime. We're going to play short for bearish trends and risk off regimes. We're going to be short, obviously, but we're not going to neglect the possibility for a move higher, and we're going to hedge for that. And let's go to ZN. Obviously, the bond trade, another misery here with back on lows here after CPI. We flushed, we came back up, and on Friday we pushed back down. We're still off the 52-week lows on these 10-year T-note futures, but we are pretty much right there. We are a long ways. We're about 11% on Momo, 11% on bonds. It's a big move. Um, and a move like this could push higher, and we could get a Momo touch, and we could shit the bed from there. That is possible. So if you're sitting here watching bonds and you say, what could happen? Well, ZN could go to Momo and be bearish trend and continue to do nothing. And we've gone over this multiple times in podcasts. We can go back in time and find a good scenario of what that would look like. Just right here alone, let's go back even better. Here's a great example where ZN is sold off so far from Momo and starts doing this chopping action. And what ends up happening is people will see a move like this where we are right now, back up to Momo and say, man, I'm missing the move. I got to get long. And that's the ultimate bull trap. Now you might say, oh, great. Well, I could long from here to Momo. That's 11%. Yeah, it's 11% move. It's a good move. It's a phenomenal move. But the problem is if you don't get that, if you just get this type of downward sideways action, well, then you're just burning your capital. So stick on the right side of the trend. This is not the place to do anything, at least not for us. We're going to wait for the trends to fill our sails. Now, I also wanted to quickly talk about regarding ES, and I put up a tweet this week in talking about how there's a potential risk on pivot. And what I mean by that, if we look at the overall risk probabilities or regime probabilities, excuse me, the total risk on probability is maybe 27%, right? And risk off is 73%. So obviously it's low. But if this were to tick up above 50% for whatever reason, pushing risk off under, ES could get a rally to Momo, no problem. Now, that doesn't mean that the regime is in confirmation of being bullish. That is just a counter trend. That's counter regime action within the trend. And this is why DDAP is so important. We have to use DDAP and the system to balance each other out. Because if the market rallies up to Momo with a risk on pivot, the question then is going to be, do we break Momo and go bullish trend? Right? That's the real question. Now, for example, let's just say we get a risk on pivot with expansion, which is growth up but inflation down. Well, not only will ES go up, but ZN could rally as well. Again, does that mean that it's time to buy bonds? Not so much. You need that real deflation pivot to make it worth it. While bonds can do okay in expansion, we want that deflationary pivot. That's where the bid really fuels bonds. If we don't get that, then it's risk on. We won't bother with bonds. We'll just go back to risk on equities. And that will only be a confirmation move or a confirmatory move if we get the move in equities to follow. So you have to double check here. And I'm just saying to be cautious because I don't want anyone to be surprised if they see something crazy. We're at VIX 30s, and we've been at VIX 30s for a long time now. So VIX 30 things can happen, right? So we're at VIX 30, VIX 30 things can happen. And what does that mean? Well, this is a VIX 30 thing where we move on ES. Within a week, we moved 6% up and down, right? From lows to highs in a week, we moved 6% or 7% almost, 662 basis points. That's VIX 30 things. And we have to say that a 17% move from here to Momo could still lead us in bearish trend and risk off total regime. So we have to, again, we have to play VIX 30 things. Now, I did publish this, where I did generate this index here to measure market liquidity. And we're going to go over more of market liquidity in a few minutes in the pre-recorded section of the podcast where we talk about reverse repos and etc. and how they affect liquidity. But I want to go over the liquidity index. So it is an illiquidity index. It's measuring illiquidity. The higher it goes, the more illiquid the environment becomes. It's compiled by using VIX, market liquidity metrics, bond liquidity metrics, and rate of change metrics for the Fed balance sheet. And the reason why we're encompassing all those components together is because we've done a lot of talking and tweeting and messaging about how the level of VIX, the rate of change of the balance sheet, and the dollar all compile into one big liquidity pool, right? Higher VIX is usually led by a declining rate of change of the Fed balance sheet. And a higher VIX is more volatility, which is accompanied by less liquidity. And all of these things, it's very hard to put on a piece of paper and find the right, I should say, representation of what you're trying to see. So that's why I created the liquidity index. And it typically does track the VIX. It works very close to the VIX, actually. And we see these moves against VIX where VIX doesn't do anything or VIX doesn't follow. And that's typically because the market is being held together. But ultimately, in the end, when the liquidity index really rips, VIX does follow. Happened in COVID, happened in 2009, happened in 2011, so on and so forth. Well, now we are faced with a big disconnect, and we'll go back to a daily chart. We can see that VIX is well elevated, and from a numbers perspective, VIX 30, right, is VIX 30, like it's something that is abnormal in the longer term. But the liquidity index is actually above the COVID peak. It is not above the 2009 peak, though. So we're in between the COVID, and let's see if we can go back to a weekly here. We're in between the COVID and the 2009 peak. So the illiquidity index is quite, say, illiquid, which begs the question is, when and does VIX follow? Well, given that VIX does track the liquidity index quite well, you would assume that VIX will see higher prints. And that's not too good because VIX 40, VIX 50 is not a good thing. And it's something that really we want to make sure that we're protected against, which is why we haven't liquidated shorts. We're more hedged for this reason. If the market does decide to shit the bed, we don't want to be unallocated.
We're recording this podcast ahead of time since I'm currently on vacation on the beaches of Hawaii right now when you're listening to this. So we wanted to get some dialogue, record this ahead of time so that we can have conversations and make it a better learning experience for everyone. So today we're going to be talking about reverse repos and what they are. It's a pretty common thing. You usually see Zero Hedge posting about it, $1 trillion reverse repo. What does that mean? There's always comments under those tweets. No one knows what the hell it means. Well, we're going to go over that and we're going to talk about what it means. So, Gamma, what does it mean?
Before we go over what the reverse repo means, I think it's important that we establish why it exists because it goes hand in hand on what it. So, the reason it exists is it's to help maintain federal funds operations. Okay. The operations behind the federal funds rate. But let's get an overview of the federal funds rate first before we go into reverse repo. So, and IOR because they work hand in hand. So, when you see the Federal Reserve come out and say like they've hiked interest rates, really what they're saying is they've increased their upper and lower limits. And when they cut interest rates, they're decreasing their upper and lower limits. And you can see on the graph here, those are marked as yellow. These are the current, as of October 8th, 2022. These are the lower and upper limits reported by the Fed.
And so what does that
Now,
mean? What do you mean by limits?
so this is where the Federal Reserve range for the the range of the federal funds rate, the upper bound and the lower bound are set by the Federal Reserve. They want to keep rates between this barrier. Okay.
Okay. And
That's
it
that's their
fluctuates, right? Between that?
Yeah, no, the rate fluctuates between this barrier, but we're gonna work like it's gonna be like a taco or like a hamburger. We're gonna go from top to bottom. Okay.
Okay.
We're gonna or even like an onion. We're gonna peel the layers and get to the middle. So the upper limit and the lower limit are set by the Fed, okay, verbally. Now, verbally doesn't mean shit, does it? If you say I want the lower limit to be 3 and the upper limit to be 325
Yeah.
basis points, right?
Yeah.
Doesn't mean anything. So, the federal funds rate, the EFFR, is really just an average traded value between these two ranges. That's really what this is. It's not an exact mean. It's an average the volume weighted average of the rate traded between these barriers, these yellow lines. But what is actually keeping the EFFR between these yellow lines? That's the IOR and the overnight repo rate. And we're going to go over that in a few minutes on how this and why this does this. But I think we should first start by explaining that the IOR and reverse repo rate are what the Fed uses to maintain the federal funds rate within its target. Like I just said, the only way that the rates stay within this target, these yellow lines, is because of these two interest rates. These
Hmm.
two interest rates operate within these two yellow lines, but it's these interest rates that set the EFFR. Okay.
Okay.
So let's give a retail explanation of what is the IOR, right? What does that mean? And what is a repo, right? In terms of the Federal Reserve, because this is reverse repo. The lower white line is reverse repo. The upper line is technically a regular repo, or we call it the IOR. So let's just say you go to a pawn shop to borrow against your valuables because you need money. Market participants, they do the same thing, except their valuables are treasuries and the interest rate on the loan is much lower than your local pawn shop. But the pawn shop itself is the Fed. Okay. So
Okay.
if you need cash from the Fed, you are going to go to the Fed with your treasuries and swap them out for cash, and you're going to borrow at the interest on reserves, the IOR.
Okay.
Now, the other side, let's talk about reverse repo. This is like a CD. This is the CD of the Fed, right? So, and when I see CD, I don't mean like a disc, I mean certificate of deposit. So, when you have too much cash on hand, you could deposit it at the Fed and collect interest until you need it again. So, in the first case here, we swap treasuries for cash. On the overnight repo, we're swapping cash for treasuries. It's a hand for hand swap. They are technically equal value, but there's what they would call a haircut to prevent to prevent any price movements from depreciating the value that you're earning. But that's outside the scope of what this does. So let's talk about what happens when the Fed conducts repos. The the first line. So when the Fed conducts repos, what they're basically doing is they're creating a ceiling for the borrow rate. Okay, this is the rate at which you borrow. It's not the upper limit, it's this rate, right? It's the Fed is saying that when they give the upper and lower limits, they're going to operate. Everything's going to happen within this range. Okay.
Okay. Got it.
So the interest on reserves, this is where the Fed is allowing someone with call it treasuries to swap and borrow money for. This is the rate. Okay. This rate is set as a ceiling for the market. Because let's just say you have treasuries, right? And you want to go and you want to loan those treasuries out for cash. Well, if the Fed is offering you 3.15%, which you have to pay, right? Because you're lending the treasuries, you need the cash. Well, if you need to borrow that cash for 3.15%, who's going to offer above the Fed? Who's going to go and say, "I'll take your treasuries for 5%." You're never going to go there. The Fed's the most liquid source. If they're at 3.15, you're going to go to the Fed. So they create a ceiling. No one's going to offer to swap treasuries out at a higher rate. Again, why would you borrow from anyone else that is offering rates above what you can get at the Fed?
Mm-hmm. Yeah.
Spend. This is not to receive. And on the reverse side, on the overnight, on the overnight reverse repo rate, what you're getting is the floor, right? So when they conduct a reverse repo, they're setting the floor at the lending rate of which interest can be earned. So, for example, now you have cash, you want to earn interest. Well, if the Fed sets the floor at 307, if someone else comes out and does it at 3 or 290, why would you go there? You got the Fed to 307,
Yeah.
right? And the reverse repo is basically like a CD. You can suck it sucks well, some will tell you that it doesn't suck liquidity out of the market, but it does into a sense that it's bringing it back to the Fed and you're getting paid an interest for it. So it's not no longer on a third party, it's back at the Fed, right? That's the overnight that's the reverse repo. So, let's establish a point here. These create the floor and the ceiling for the EFFR. the floor, excuse me, the floor and the ceiling. I said it backwards. So the IOR is the ceiling, and the on the overnight reverse repo is the floor.
And so that's how they maintain the
The
EFFR.
yes, right. So there's this common talk that's been going around lately that I've heard it on at least on a few YouTube channels over the past couple of weeks. That's why I'm making this video. That there's some theory, I don't remember who, but they believe, or these groups of people believe, that the Federal Reserve can stimulate the economy by dropping the reverse repo rate and keeping and hiking. So basically, the Fed's going to continue to hike interest rates and continue to do QE. Right? Everyone understands that no one's. I mean, there are pivoters, right? Guys that believe the Fed's going to pivot that are fighting that. But overall, everyone believes that the Fed is going to still hike interest rates at least the next few meetings, and balance sheet reductions are coming. This odd theory is, well, the Fed can just drop the reverse repo rate and decentivize all that cash that's sitting. It's about $2 trillion at the Fed, and that will get pushed back into the real world. And it's like a liquidity injection, right, into the market, because things that use the repo market are like money markets, right? So, for example, let's just say you're a bank and you have $500 billion, or you're a money market fund, you have $500 billion in your fund. Well, it's a money market fund. It's not supposed to fluctuate, right? Money market for a reason. So
Mhm.
how do you get interest on that? Well, you do it through the reverse repo. You lend that money to the Fed, and in turn, they swap securities. They swap treasuries with you. It's actually done title by title. So meaning, like, the money market doesn't actually lose the ownership of those dollars. They're just converted to dollars ownership in treasuries at an overnight rate. Oh, well, it's an annual rate, but it's, it's annualized. The 3.07 is an annual rate, but obviously you're not getting 3.7 overnight, right? So that number is then, I could call it de-annualized, and you then receive that interest, and then you have to participate. Well, depending on the repo agreement, they can be 1 day, 1 week. Typically, they're overnight, so they're 1 day. And then you would do the repo again the next day. So we have $2 trillion consistently going into repo. We're sitting at the repo facility, right? The idea is, oh, let's cut the overnight repo rate and just drop it, and that will mean that people will no longer seek to have that interest at the Fed, because that they can find better yields elsewhere. If they were to drop the 3 to 2, right, you could find better than 2% somewhere else.
Mhm.
Better than, yeah, but right,
So
better than 2%.
so then money goes out into the market instead of to the Fed, increasing liquidity.
Right, but the problem with that is you have to understand that the overnight repo rate is used to control the EFFR. If they drop this to 2%, it's basically cutting rates,
Hmm.
right? Because the
Yeah, because
volume weight average, yeah,
that's what's holding up the EFFR.
right, right. And that's something that you need to pay attention to. Now, the overnight repos are also seen as, some people will tell you that they're not liquidity drivers, because technically the money is still there. It's, again, maybe locked up for a night. So that money can come back very quickly. So it's not like that money is gone, or locked away for years in some alternative investment. It's somewhat liquid, right? Essentially, they have treasuries in turn. The reason why the repo rate is so high, okay, like we're at 2 trillion, and we'll go over that in a second, is because there's a lot of cash on the sidelines, and treasuries are not viable. If you really want to, we'll bring up another norm, like a retail explanation on this, and dumb this down. If you're saving up $500,000 for your house and you're at 350, right? You got 350 cash in the bank and you want to get to 500. Would you buy a bond right now at that 350,000?
No, definitely not.
Right. Well, but you want to earn interest.
Hmm.
So why not do overnight bond swaps on the Fed, where you're guaranteed your payment back plus some interest the next day?
Hmm.
It's only 1 day, right? So you'd rather suck away yield on the overnight repo than hold a bond, because we don't know what the bond volatility alone is ridiculous, right? And on top of that, we have rates going all over the place. We don't really know. Rates can fall off a cliff, and yeah, if they do, your bond investment for that house is going to do great. But if the Fed has to push rates above 5%, by the time you buy your house, you might be down 10%, depending on what bonds you buy, 15%.
Yeah,
So
so this is like the best risk-free
right,
return if you don't know what to do with money. You're just gonna
right.
pile it into here.
Exactly. And that's why you're seeing, let's look at reverse repos right now. Let's take off actually it's already on here. So let's look at the reverse repos versus the dollar. Let's pull the see if we can move this dollar out of the way so I can show you guys what this. Yeah, there we go. So this is a reverse repo right now. As you can see, this was prior to COVID. Thing was pretty much zero. No one held money at the Fed because again, in zero interest rate environment, why would you keep your money at the Fed if you could do literally anything with that money?
Hmm.
Then leave it at the Fed.
Yeah,
Once rate hikes started, so did the repo
because now
the
it's more
reserves and
it's
repo.
more favorable,
Yeah, but
especially
we're
in a highly volatile environment where there's nowhere else to put your money.
right. And even look back to 2015, 16, 18, 19. Repo was never this high. Repo skyrocketed. Repo's at 2 trillion, right?
Yeah.
And I'm telling you that this is one of the first times in many, many years where the stock bond correlation is positive. So people know that cash is more valuable as cash. And if they have to overnight swap them for treasuries back and forth, it's better than actually holding on to a bond and collecting that yield because an overnight repo, as we can see here, they're paying about 3.307 basis points, right? So let's look just quickly at a US you want a 3 month, right? Let's just say we're talking our let's see, can we get 1 month? You want a 1 month bond yield. Paying 2.97. You're not even getting that yield on you're getting
Wow.
more. Yeah. Well, actually, you know what? Yeah. Yeah, you are. Oh, you know what? No. No, you're right. I'm right. Yeah. You're getting more you're getting more on repo than you are on bonds. I apologize.
Interesting. And it's
Right.
it's less risky too.
Of course, because this thing can fluctuate. The bonds can fluctuate. You buy this bond for 1 month. What happens in 1 month? Do yields go down? Listen, reverse repo typically is 1 day. It's just
Yeah.
better. Leave your money in reverse repo. But the big thing that has come from this is everyone says, "Oh, reverse repo," or some people on Twitter I've seen say reverse repo does not create liquidity problem. Their idea is that liquidity hasn't actually changed. It was cash sitting in a money market fund, but now it's in reverse repo. It hasn't gone anywhere. So how does that mean it's changed? Technically, from a asset transfer standpoint, no, it hasn't changed. Liquidity has not changed. But the fact that we have 2 trillion in reverse repo compared to 2020 when we had zero, that's the liquidity change. It's the big picture. Look at the dollar. This is something we got to take a look at. The dollar only started reversing after reverse repos picked up. You notice that?
Interesting. Yeah.
And it's most likely going to peak once reverse repos break down. This is $2 trillion sitting at the Fed.
Yeah, but when do reverse repos break down? There needs to be an alternative investment to
Right.
park your money,
Right.
which, that shit's going to hit the fan before that happens.
Yeah. And that may be the case. There may be a case here, which we obviously don't know until it happens or until we start seeing signs of it happening, that we get deflation where the bond trade pivots, but the dollar shits the bed.
Mm. Yeah,
Just
because
how this stagflation is I'm sorry, I'll let you say what you're going to say, but just because the way the stagflation regime has been, it's been so right field abnormal, right? Or so left field, I should say. It's it's not that crazy to think about the same thing could happen with deflation, where the dollar actually goes down, whereas bonds are going down now in stagflation, they typically segue to go up into deflation. They've been going to shit. So could it essentially mean that we get to deflation and the dollar actually goes down?
mm, and oh man, that would confuse people.
I know it would confuse people. And you might say, okay, well, is there really a correlation here between DXY and reverse repo? And I'll tell you, yeah. I mean, look, every time here we have a peak, right? In reverse repo in December 15. After that, dollar shits the bed. Here, the peak is above this peak, or just about, right? Let's take a look.
Well, we've
Or
never
just about.
really had anything like we're seeing today, so
Well,
it's kind
that's
of
why I'm
uncharted territory.
to a degree, but what I'm trying to show you is look at these spikes and look at the dollar. Look at this. This is COVID, right?
Hmm.
And look at this.
Interesting.
So when reverse repos take off, dollar goes up. And that just makes sense, right? 2 trillion of dollars is not eight, meaning this is a constant indicator that $2 trillion has left the market. If it's in money market funds, right? That can change in 10 seconds.
Right.
If it's in a reverse repo, well, it's got to take at least a day to change. So until this starts breaking, it's a confident signal in that the dollar remains king as cash heavy investments make more sense to people at the moment. People would rather hold more money in reverse repo than anywhere else.
Yeah.
So when you hear the word cash is king, yes, it is, especially to a degree where cash is sidelined and it's getting better yields with lower volatility, better volatility adjusted yields. So why even fuck with it?
Yeah.
Just go there. And that's what's happening. And that's why you're seeing like again, the dollar. Here we could take a quick look. Look at this. Reverse repo falls down, dollar down. Reverse repo off highs, slowly petering sideways, dollars falling apart. Every time reverse repo rips the new highs, the new dollar highs are on the way. Not- It's not really
Yeah.
rocket
It's
science.
it's 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 like almost an exact correlation because it's liquidity.
Right. It's liquidity, but outside of the scope of what someone that understands how the Fed works would tell you, because it's not on paper. That money is that money's already cash from where it's coming from. To become a reverse repo, it already has to be cash. You understand? To
Yeah.
go into the reverse repo operation, you're just swapping cash for treasuries. It means you have to have cash in the first place. So that liquidity effect is not real, but it is in the sense that it's non-spendable.
Well,
It's not spendable.
just for a very short period of time.
Right. But this has been going actually higher over
Yeah.
time, right?
So that's
So,
basically that chart is showing every day there's $2 trillion in one day. And then the next
exactly.
day it would be another $2 trillion.
Yes. Yes. Yes.
Yeah.
Now, just remember there are I believe this is the overnight one.
Well,
But
so very
there,
quickly this could reverse if there's an alternative somewhere else to put your money. It could easily be, go down to 500 billion in a day.
sure, but that would be, just remember that this is not all, the reverse repo operations are not just all one day repos or reverse repos. That I should clarify. They have different terms. Typically, it's one day. You understand? But it could be like someone could have if you really wanted to, you could have a 4 day, a 1 week repo, a reverse repo.
Okay.
But for the sake of this conversation and what we're looking at, yeah, it's pretty much daily. And yeah, you're right. This can fall off very quickly, but I don't think, let's put this into perspective. This type of slam down to 500 billion, which would be down here, that would mean $1.7 trillion got moved into the market. Into what? Into bonds?
Hmm.
But that would also mean, what happens to DXY if this thing just falls off a cliff? Does this thing go down, limit down in the futures? You know what I mean?
I
Like
hope not.
well, we have to see like how this unloads, and this idea that this can be quote unquote stimulus for the market, is the idea is that this is $2.2 trillion of gunpowder or dynamite ready to be put to work, or bullets, whatever, however you want to put that
Yeah. So
analogy.
basically when the bond trade comes,
This
that's
probably shits the bed. Yeah.
that's the amount of money you should expect to hit the bonds.
That would be insane. But
Yeah.
just remember, they can't drop the overnight repo rate without affecting the effective federal funds rate. So this idea that the Fed has this backdoor stimulus plan to drop to drop the repo rate, or overnight reverse repo rate, right? Um, to stimulate the economy with and still hike and tighten is not logical. Makes no sense.
Yeah.
And we can just take a look at VIX and the balance sheet and the dollar in general. The dollar's been on a tear. It's on white. It's the white line here. VIX is orange and the balance sheet is blue. We've gone over this in much depth and kind of consistently over the last few months here, that a falling balance sheet is VIX positive. Okay. A rising balance sheet is VIX negative, meaning a rising balance sheet is a VIX suppressor and a falling balance sheet is a VIX enhancer. As you notice here, as the balance sheet was rising, VIX almost seemed to be climbing into this tight little wedge. And it's once the balance sheet peaked, started moving over, just actually before VIX started getting more volatile. Well, same over here in 2018. The balance sheet starts rolling off slow and slow. Every month we're getting lower and lower prints, and VIX out of nowhere starts having these huge moves. It really wasn't until this started happening. Look at VIX, calm, 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 and then boom, 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 and everything gets more volatile. And then when balance sheet starts rising, look what happens to VIX. It goes down, it gets tight again. And the balance sheet, obviously, their objectives are to let assets roll off and pull this down in value. To what degree, we don't know yet, but or to what degree that they're going to take this to, we don't know yet, but we know that they're going to just let things expire and slowly trim it. That's going to be positive for VIX. Also, the rate at which they do it will affect the added volatility to VIX. But long story short, this is on the downtrend, and VIX therefore should have more volatile ranges, meaning market volatility is not going anywhere yet. And if we overlay the EFFR, just so you can get a better idea of what's going on here, you can see that just because rates are hiking via the yellow line doesn't mean VIX is becoming volatile. It's the balance sheet that at the end determines the factor of where VIX vol is going.
Yeah,
Because we've
because
seen,
that's direct liquidity injection.
right, right. That's the falling balance sheet is liquidity that is basically being removed from the market,
Yeah.
right? And again, we can take a look at the reverse repo. Reverse repo is so high right now. Liquidity has been reversed and it's going at some point. This is not going to be 2 trillion forever. It's not. And at some point, this will roll. And where that money goes, we'll find out. Listen, we could get a risk on regime, equities bottom out, whatever. And this could go right into equities. We don't know yet. But a big part of this tells me that there's more conservative money here than speculative money,
Yeah.
right? So I have a feeling this will go more towards fixed income when there's a more of a directional play, but we'll see. Again, those are my feelings on it. But like the reverse repo facts and the Fed funds facts is literally what we see on the screen. We have the upper and lower limit. Fed sets the playground. The IOR and the reverse repo, they run in between that playground. And out of that, we get the EFFR. So if you can't drop or rip one of these without affecting the EFFR, and that's
Hmm.
something that we need to pay attention to, where the Fed funds goes with overnight repo versus local sourceable treasuries, what we can get. Just remember, the overnight repo is at 307, and we just saw a 1 month treasury bond, not even at 300 basis points. So what's the point? When does this become less lucrative as an investment? And when this becomes less lucrative is when we see a spur in market liquidity. I think that's where we can end this podcast today.
Yeah,
Um,
that was fascinating. That
yeah.
no one has explained reverse repo like that.
Nope.
It's I've looked it up in the past, and you get your typical Investopedia articles, you get some YouTube videos of some schmucks talking about it, but wow, this really puts it into perspective, and like the
Yeah.
just the connection with the market and the liquidity aspect of it. It's pretty
Right.
interesting. It's really
Yeah.
interesting.
Yeah. I think that a lot of people tend to overlook these things because they see again on Twitter reverse repo. A typical individual that has no idea of what the Fed does or what how they structure the federal funds rate doesn't understand what a reverse repo is. They hear repo, they think they're going to get their car possessed.
Yeah.
They don't know what the fuck that is going on. So I think it's really good that we clarify this. Um, and I think that going forward, we can encompass this more and more in talking points because I want to make sure everyone understands it before we really start talking about it. And it's something that we're going to be watching now. Reverse repos. Where's that money going? That $2 trillion. We'll keep tabs on that. Does the bond trade appear and then reverse repo start shrinking? Oh, wait, we got extra stimulus here for bonds. That's something that we'll definitely watch going forward. But again, if you have any questions, feel free to reach out to us on our Discord. The link is on our website at www.market-radar.com. Please like, subscribe, this channel. This way, every time we drop a video, you're always in the know and you know what Market Radar is thinking. Thank you so much, guys. Have a great week.